Hi everyone, hope you're all doing well. Welcome to probably the most popular video that I do on the YouTube channel, which is the UK stocks I am buying. So today I'm going to go through the 8 UK stocks that I've been buying and also the stocks that I've been selling. These are all the moves that I made in my UK portfolio between the 1st of August to the 1st of September. It's, like I said, the most popular video that I do on the YouTube, and I think the reason why is because every move I make in the UK stock market portfolio are in these videos. So any moves I make, you'll be able to see buying or selling, and if you go back to previous versions, you'll be able to see exactly the same. So there's no hiding. If the stocks work out, they'll be in that video. If they didn't work out, they'll be in that video as well. So hope you enjoyed the video. Gives you some ideas for some stocks to look at on the UK stock market. Everything I'm buying is for a long-term hold, which is 2 to 5 years to me, and I do aim for 100% return when buying these investments. So I hope you enjoyed the video, guys. If you could, hit the like button. If you're new around here, subscribe. We are really pushing on to that 20,000 subscriber mark, and if we could get there, that would be absolutely amazing. Apart from that, let's get started. Now, as always, if you do want to know what I'm buying and selling in real time, the place to be is on the Patreon. As well as that, I give you 2 exclusive videos a week on there as a thank you for supporting the stock market content. If I didn't have the Patreon members, we wouldn't be able to put this video series out on YouTube. We wouldn't be able to do 5, 6, 7 videos a week on YouTube. It's all because of the Patreon members. So thank you if you do support the YouTube channel through the Patreon, and hopefully you enjoy the exclusive videos on there, and also get the Discord with 600 members on to talk about stocks, including me. If you do want to join, links in the description, guys. £6 a month, or if you do want to pay yearly, it is £61, I believe it is, for the full year. So if you do want to join that, links in the description, guys. And if you do want to start investing, join eToro with the link in the description. I am a popular investor on that platform, and you can follow along with me on there as well on eToro. So today, we're going to start with the sells. Just like the US stocks, we're going to start with the sells. And the reason why is because there was a lot of them. And overall, I think we sold between the UK and the US portfolio, we did about 15 trims, which is unbelievable. There was a very good month in the last month where we managed to lock in a lot of profit, and I think it's worth highlighting, because at the end of the day, why do we do this? Why do we do this investing game? It's to make money. So if I didn't highlight the success sometimes, you'd be kind of like, well, what's the point of investing if you never make any money from it? So first of all, Zotefoams. I did take a little profit off Zotefoams. What a couple of months this has had. So since investing in this at the start of the year, the stock is up a whopping 53%. I personally am up somewhere close to that at the moment. And with all this tariff news that's been going on, these guys come out with ahead of expectations trading update, which is just incredible. And even in the last month, if you remember last month, I told you guys when we were doing the August stocks I was buying, do you remember it had a big dip selling off into earnings, and it was that panic mode of like, oh, what's going on here? Does the market know something we don't know? And then they come out with the trading ahead of expectations update, and boom, what a rally it has been. So I did trim 5% on my Zotefoams for a 45% gain. I did trim another 5% on my Zotefoams for a 30% gain. And then I also trimmed another 10% on my Zotefoams for a 40% gain. So just locked a little bit of profit in on Zotefoams over the last month, which has been absolutely great. It's always nice when you buy a stock and it goes straight up after you buy it. Doesn't always work out like that. Next one I sold was Bytes Group. So I only walked away with about a 2% return on Bytes Group. Did buy after the profit warning here. Since then the stock has rallied up a little bit, so maybe could have held it a bit longer. But the reason why I sold Bytes is I just invested it into another company, and when I tell you about that other company, believe it or not, this company's actually even outperformed Bytes with the rally that it's been on. So that was at the moment looking like a good decision in the short term. We'll see if it's a good decision in the long term. The other one was Audio Boom. What a year this one has had, nearly up 100% in the last year. So this was a stock that I started buying about the back end of December time, and we had a massive rally in February. I had a bit of a pullback during May, June, July, and I was buying back into the stock, and then we've had another big rally up in Audio Boom. So once again, a new stock into the portfolio, but straight away has been making us money, which is absolutely fabulous to see from Audio Boom. We locked in a 5% trim for a 40% return, another 5% trim for a 50% return, and another 5% trim for a 60% return. So yeah, really nice performance from Audio Boom there. And the last stock I did trim was JD Sports. So this had a massive sink a couple of months ago. During June time, entered the 70p range. Don't know why it went that low, because yeah, there was a bit of a trading update during that time frame that was a slight profit warning, but we were only talking 1-2%, but the market decided to send it to 70p. And it was about 7 times forward earnings, which was just incredible. Now, even right now, I still think JD is very good value. But just with the stock rallying up so much in the last couple of months and me buying so aggressive, I just wanted to take a little bit of profit off the table. You know, we're here to make money at the end of the day. And what it does, it just allows me to have that little bit more capital, so that if JD was then to go back again to the 70p range, I could add more back in. It's easy for me to average down on a bit of a smaller position. So it's just managing the position slightly, making it a bit of quick profit, and that's what I do. I position myself that if JD Sports carries on running up from here and we do go to the £1.50, £1.80 range, I'm a happy bunny, because we end up still having 90% of the position in there and making a lot of money. And then if the stock goes down in the short term, well, I'm happy once again, because if the stock goes back down, I've locked profit in from the recent bounce, and I can go buy more shares again at 70p, and we copy and paste what we just did. So yeah, I did sell about 15% of my JD position for about a 16% return, and then I sold another 5% for a 20% return. So we'll see what happens to JD from here. The other thing that's probably worth pointing out is that they did a bit of a trading update, and I actually didn't think the trading update was that amazing, but yet the stock rallied off it. So that was also another factor there. But still a fan of JD in the long term. So we're going to move to the stocks I've been buying now. There's 8 stocks on this list. We're going to start with this one today. We're going to start with B&M. I was buying B&M. We did see B&M enter the £2.18 range in August, which really surprised me. I did not think we will kind of break below this £2.40 range, but we did. A bit like what we were just speaking about JD Sports, it did a bit of an update, and the market took the update as a bad update, and I actually thought it was a massive step in the right direction for B&M. And a bit like JD Sports is that B&M has been absolutely destroyed in the last year. If you look from the highs of 2024, the stock's fallen over 50%, and same again, I look at B&M and I think, you know what, yeah, they're having a bit of a tough time, things could be slightly better, but you're talking like 1-2% profit warnings on B&M. You know, you'd think right now the profit's fallen in half with B&M, and that's just simply not the case, and it just seems way too oversold right now with B&M. B&M, I'm sure most of you guys know what it is. I'm sure most of you have one of these stores near you. I actually really like B&M. It's quite a common occurrence that I go in for one thing. Next thing you know, I've bought 4 or 5 things. And it's probably the only store when you go onto YouTube and TikTok, and people actually make videos about what B&M have in the store, with the likes of the Christmas sales, the autumn sales, the Easter sales. So very popular with influencers for a retailer, which doesn't quite happen with a lot of other stores in the UK. What's also good today is the high street. Another good set of data for retail sales in July, and I'm thinking with the warm weather, obviously when the warm weather comes, you're out, you're doing the shopping, you're especially going to garden centres, which obviously, as we know, B&M have a few garden units on the side of their stores as well. So with the warm weather helping out the high street, I'm hoping that the Q2 update from B&M is good. What was also another bonus that came out today, yeah, it was today, I can't remember if it was today or yesterday, that's how long of a day it's been. But the new CEO that's come in and hopefully going to turn around the business, he has just dropped, I think he made another buy previously, but today he just dropped a 6-figure sum of insider buying of shares. Wow. If it was like a 5-figure, I'd have been like, oh, that's a really good sign. But the fact he's just being willing to drop another 6-figure amount into the stock, yeah, that is, I could not ask a CEO to do more than that. That is a very impressive sign from the CEO. And like I said, the last update they brought out, they brought the Q1 update out on the 15th of July. And I actually thought it was good. I don't understand why the stock has continued to bleed since then, because the revenue was up 4.4%. Like for like went back to positive growth, as we can see here, and also which was 1.3% as well. And also it talks about some of the things that they're implementing from the new CEO is having a positive impact. Yeah, gross margins were down slightly, but they said, you know, we've got line for sight that we know these are going to increase towards the back end of the year, so we'll be okay from that point of view. And I was thinking this was so much better than the previous quarters, and yet the stock went down off it. I was like, I don't know. We know what the market's like in the short term. It can be absolutely ridiculous. And, you know, B&M now, we're sitting around about 7 times 2026 numbers, 6 times 2027 numbers. And historically, B&M has traded a lot higher than this sort of earnings. You know, if we go back to 2024, this was about 15 times earnings business. I would expect B&M to normally be somewhere between the 13 or 14 times earnings, which obviously, if you look at the current P ratio, is nearly double the share price from where it is right now. And obviously, to factor in, you know, you're getting a lovely 6% dividend yield, and if they do that special dividend that they sometimes do, that puts you onto 11% dividend yield right now. So yeah, I am still hoping that B&M does really well. In fact, I'm actually quite happy with B&M, because like I said, I actually thought the last financials were pretty good. I would even say they were probably better than where JD Sports is at the moment, and JD Sports is having a pretty decent bounce in the last few months. So I don't know, the stock market, guys, in the short term, it's a crazy thing. So we'll see what happens with B&M. Moving on to number 2, Manolete Partners. So this was a new position into the portfolio last month. This is the reason why I sold my Byte stock. I looked at this and thought, would I rather own Bytes or would I rather own Manolete? And I decided to move the money from Bytes to Manolete. And like I said, it's actually worked out even better, because the stock is currently up 38% in the last month, which is pretty impressive going from Manolete. Now, I did drop a video in about 18 minutes long on this one for a bit more detail if you want it. That'll cover it into a bit more detail than what I will do today. But yeah, post that video there. 2.8K views as well, so hopefully some of you guys had a little bit of a look into Manolete Partners. I received a lot of negativity on that video as well, which I was really surprised by, but you know, shows you we always come out on top in the long term over here. If you are looking at it, what I would suggest you go do is go watch this video here, which is the Manolete Partners Mellow presentation. You can get this through their investor presentation on the website, and that's 38 minutes long, and you can listen to the CEO, and he gives a lot of fantastic information out in that presentation over there. Now, what they do is they are a litigation financing company. So what they do is they purchase claims from insolvent UK companies, and they take over this insolvent case that's currently going on with the business. Now, what happened during 2020, during the COVID time, you can see here there was a massive drop off in the cases. As we know, for the next 2 years, basically the government went, hey, we're not letting any company go bankrupt at the moment. We're going to protect you all. We don't want people losing jobs. And then it got to the back end of 2022 when the government kind of went, right, we're knocking that on the head. It's everyone for themselves again. And we've started to see the amount of cases starting to recover at the moment as well because of that. It takes a while for these cases to go through all the process. You know, you're talking 12 months, 24 months. And then as well at the moment, as we've seen out there in the UK economy, it's not looking good, is it? And there's a lot of companies at the moment struggling, and obviously a benefit from that would be Manolete. And if we look at the recent trading update year to date, that's what they're saying. They're saying that at the moment, they've currently signed 56 new cases, 27% more than the 44 signed for the whole first quarter of the financial year last year. And also what they said at the moment, they've purchased 5 cases with a headline value of in excess of 1 million compared to the 3 1 million headline cases last year. Now, the big thing is that because of the COVID situation, there was a lot of slowdown of the bigger companies that have access to funding. They obviously from that time have survived a bit longer, because when you're a bigger company, it's a bit easier to get access to capital. But now we're also seeing some of these bigger companies now starting to catch up with some finance issues, and because of that, some of these cases are now starting to recover in size as well. Now, for someone like a Manolete, is that if they take a case on, they roughly make the same profit margins, or the expenses is the same as let's say a 300,000 case than a 1 million case. So if you're taking on a 1 million case, basically anything from that point of view is the point where the bigger amount you take from a 1 million case would be exactly the same. So a 1 million case would lead to so much more levels of profitability, which is key to point out. So because of that, it's currently 16 times forward earnings. It was actually 12 times forward earnings when I was buying the business myself a few months ago. And what we're starting to see now is because of the recovery of the cases and the value of these cases, we're starting to see a big growth in the revenue growth and the profit growth, as you can see here. Remember, these cases will settle in the next 12-24 months. So these surge of cases will start coming into the financials in 12-24 months time. And you can see this from the forecast from Manolete Partners. Now, previously to the COVID situation, and this company was absolutely firing. You can see here before they went in, the company was doing very well on the revenue point of view and profit margins of 34%. Now, you can see the big drop off because of the whole COVID situation, and now we're starting to see the recovery happen. Now, we'll see what happens, but obviously they're expected to do 43 million in 2028. At the moment, they're only expecting 10% profit margins, but I tell you, if they get anywhere close to where they previously did, even 20% profit margins, let's say, and they do about 10 million in profitability, 10 million of profitability on a 48 million market cap, it's not hard to see how this company could do very well. So yeah, I'm a fan of that one. Moving on to the next one, Watches of Switzerland Group. So this has had a tough couple of months. This has just continued to bleed massively, down 30%. And I don't really know why. This is another example of I don't know why the market is completely selling it off. I thought it was the fear around the tariff situation, but as you can see here, this week they brought out a trading update and then the stock has decided to bounce, and I feel like the stock should really continue to bounce on here because it's been bleeding for no reason that we can see financially, and they even came out and said like, hey, look, we're actually doing really well at the moment. So yeah, I think this is a pretty interesting opportunity right now. Now, Watches of Switzerland, I'm sure you've seen them. They're the retailer of luxury watches and jewellery, and is one of the only places, because Rolex don't sell directly to the consumer, one of the only licensed places where you could go and buy Rolex, which is obviously a pretty cool thing to say. If we look at the growth expansion for Watches of Switzerland, they've been doing quite well in the UK and Europe, but the big growth driver for these guys is the US growth, the US expansion. So if you look at the expansion of the US, you can see here it's been a very good expansion with very good amounts of growth. And you can also see here that the revenue mix now has gone from 24% up to 48%. And I think this year is going to be the point when the US actually closes to more of a big amount of the company, which is great because it's obviously growing at a lot faster rates. The US consumer is a lot better off than like the UK consumer. And wonder if it opens up the potential that, hey, this comes a US listing as well at some point. But yeah, they came out with an update this week. I covered it on the YouTube channel, but you know, the market's been selling it off, and maybe it's a panic around the tariff situation, but they came out and they were like, yeah, we're on track to hit our full year expectations. And they've even they actually sounded very positive as well with how the trading has been going. And you look at the company right now, and this year it's currently going to be about 8 times earnings. And if you look at Watches of Switzerland Group, you know, previously Watches of Switzerland Group has been about 17 times earnings, 15 times earnings. So it's trading about half the metrics of what it normally does. And I would say that's about a fair valuation for Watches of Switzerland, because realistically, like we said, it's your only way to really invest into a company like Rolex. And with Watches of Switzerland Group, when you're in an industry where Rolex is, you know, only appreciating value over time, it's a pretty solid industry to be in. So yeah, I'm a big fan of Watches of Switzerland at these levels, and especially now they've just come off a pretty good strong update as well. Moving on to the next one, number 4, Greggs. So it's not often you see a time frame where Greggs is down 50%. If you look at the stock chart of Greggs, yeah, there's not many times it's dropped. The only time is during the Ukraine-Russia situation, and then we had the COVID times. Apart from that, it's very rare that Greggs has such a significant drop. I think you would have to go back to 2008 for it to have even a close amount of a drop to that point of view, which shows you that, yeah, it's a significant amount here. And it's the fact that it's dropped more than the Russia-Ukraine situation as well, and nearly to the levels of where it was at the peak COVID time is very, I was going to say impressive, but I don't know if that's the right word for it, to be fair. But yeah, the stock, you know, Greggs are having a tough time. It's no surprise, you know, I think we've all seen the shoplifting videos out there at the moment, and obviously there's a lot of investments going into Greggs. We know they've been hit by some of these government changes at the moment, and it's just been one of those things where it's all kind of hit them at once. But I think Greggs will bounce back from this time frame, whether that be just securing up the where they put the products, if they put it behind the till, if it's the point of view where some of these investments into the supply chain start paying off in the next couple of years, whether it's these self-checkout kiosks, you know, help manage the NI increases and just things like that. I think it'll all balance out for Greggs. Now, like I said, even though they're in a bit of a tough time, you know, I think some people forget about this. The financial from Greggs has still actually been okay. You know, the revenue growth is still pretty strong. You know, if you look at first half sales was up 7%. If you look at like-for-like sales, that's up 2.6%. You know, this is no slouch when you look at the revenue growth. And sometimes people say about the saturation point of view. I don't think there's a saturation point of view, otherwise you won't be growing at these sort of levels. But the issue is this EPS, and you can see the EPS is below where it was last year, and that is the issue. But like I said, I think they will resolve those issues from the issues that we just mentioned a little bit earlier. And it's not often you get Greggs at 12 times earnings. It's very rare that you get it at those sort of levels. And you know, when you do look at Greggs, it's historically been a bit of a premium on the UK market. 19 times earnings, 19 times earnings, 28 times earnings, 26 times earnings, 20 times earnings, 24 times earnings. I don't know if Greggs will ever be a 24 times earnings business again, but I certainly think 10 times is a little bit too, or 12 times is a little bit cheap for Greggs. I think it should be maybe towards the 15, 16 times. And as well with Greggs, you know, you're going to be picking up that nice 4.25% dividend yield as well, which is pretty nice. So yeah, I like Greggs. Moving on to the next one, Warpaint. Now, I don't like saying a bit too much before companies report earnings, and that's the case with Warpaint. They are going to report their interim results next week, so I'm going to keep this one a little brief for them reasons there. But yeah, this one's having a bit of a major pullback since the highs in July 2024. Stock's down about 54%, down to 12 times earnings, and you do get nearly a 4% dividend yield from Warpaint at the moment. Now, if you don't know Warpaint, they are a makeup brand. I'm sure if you go ask your missus, or if you are a lady yourself watching this video, I'm sure you'll be speaking about Warpaint pretty positively. The makeup is referred to as being a very decent quality of Warpaint. They normally do dupes, and then after you try one of the dupes, which is like a copycat of more an expensive brand, you're like, oh, this Warpaint's actually pretty good. And then you try some of the other brands that Warpaint currently do have. They've had a lot of success in the UK, and now they're really branching out to the likes of Europe and also the US. They brought out an AGM statement which showed that the US was looking a little bit weak, or weakening a little bit, but apart from that, the company was still expecting decent growth, and it was expecting margins to increase, so profit will grow faster than revenue. And given the time frame that we've been in the last few months, I thought, okay, that's fair enough. And then you look at the stock and it's just sold off massively, all the way down to the point now where it's 11 times 2025 numbers, or as I like to do is start looking at next year's numbers, because realistically we're only 3 months away from next year's numbers. 9 times earnings on that one here, which is just way too cheap for someone like a Warpaint. You know, to compare it to someone like Elf, who is growing exactly the same levels as a Warpaint, and obviously has the benefit of being a US company, and as we know, these US companies always seem to trade at more of a premium than these UK companies. But just to show you, Elf Beauty, that's growing exactly the same as Warpaint, is currently 38 forward times earnings, which is just incredible. You know, Warpaint is what, a quarter of that value nearly. It's just insane. And you know, you look at Warpaint, you know, great performance previously under the management team. They still have 17% profit margins. Financial health wise, a lot better balance sheet than someone like an Elf. Strong position, cash generative, and a clean balance sheet with no debt. And from an ownership point of view, you know, you got a founder-led company here where both of them own about 20% each, which is obviously fantastic. So I just think this is way too sold off. It's historically been a 30 times earnings business, and granted the growth is a bit slower than where it was in the last couple of years, but I think now where it's at is just way too low. Next one, WH Smith. So these guys basically ballsed up their accounts, and the stock dropped a significant amount, down 40%. And you know what? Yeah, it was a rookie mistake from WH Smiths. They shouldn't be making errors like that with the accounting issues. But I don't think they've been fudging the books, and I think a 42% sell-off is a bit too much. So this drop was enough to get me into WH Smith, and I think they'll manage out of this error that they've made with the accounting, and the stock will bounce back once the market calms down a little bit from this situation. Now, they've been doing something really interesting. They've been closing, or they've sold off for basically the high street business for absolutely nothing. And what they've been doing is they've been going into travel. So travel in the likes of airports and train stations. And the reason why they're doing that is because if you're traveling, you're a bit limited on the choices that you can do. And as well as that, there's a lot more foot traffic going past these locations. And that's where they're seeing a lot of success at the moment. You look here on the total travel, it grew 11%. But they've got this kind of high street that's been weighing them down. But obviously, they've got rid of that now, which is also great. So now we're just a pure travel company, and we've been growing at 11%, which is some absolute fantastic numbers. The other thing is when you look at profit, the profit has been going up 20% on the travel business in the UK, and the like-for-like revenue growth is up 10%. This is very strong like-for-like growth, which is fantastic. So yeah, this travel business actually looks very good. Currently trading at 9 times forward earnings, when WH Smith previously has been 25 times earnings. If we go before COVID, 21, 17, 15, 14. So yeah, when I look at someone like WH Smith, I look and I actually think like this business is actually performing better than a few other retailers that have Greggs, B&M, JD Sports. They wish they were growing like for like at 10% and profit growing up at 20%. So these are really fantastic numbers, and I can kind of see why it's been on a bit of more of a premium recently. And I don't know if it'll go to them sort of premium, but I certainly think 15, 16, 17 times earnings. And same with WH Smith as well. While I wait, I get a lovely 5% dividend yield as well on it. Moving on to the next one, which is Taylor Wimpey. So I have added into Taylor Wimpey. The house builder space has been massively slumped since the interest rates started increasing, as you can see here. There was a little bit of a bounce up as the market started thinking, okay, we were about to see the house builders start recovering. The recovery never happened, and it has sold off another 40%. And that does put a lot of these house builders now actually below their lows in 2022, which is very surprising to see, and actually way below the COVID lows. So the housing market at the moment, the UK house builders is forecasting at the moment basically no recovery in the housing market, which is really surprising to me, because at some point I think this housing market is going to recover. We are going to need people to go out and buy these homes. Interest rates will eventually go lower. And you look at the moment while you wait, you're getting a lovely dividend as well from Taylor Wimpey just to keep you warm while you wait for it to happen. Now, the latest earnings showed not much life of recovery at the moment. They did swing to a first half loss, but that was actually because of a one-time loss from a one-time cost from a fire cladding provisions. So nothing too major. Well, I say nothing too major. It certainly is a little bit major, but I don't think that's something that you're going to see all the time as well. They did sort of bump down the dividend slightly, but nothing too major. But yeah, I mean, you're looking at Taylor Wimpey right now, and they're expected to do about 289 million of profit, which is obviously way below where they were before the whole CV stuff, which is like a 674 million. So if they're able to get to somewhere at that point there, and that should be a bit maybe slightly easy as well. If you look at house prices, house prices should increase a lot higher than where they were in 2019, and 674 million on a 3.5 billion market cap is obviously not too bad there. And also they've got a lovely balance sheet here at the moment. You've got an insider buying a couple of shares as well, bought around about a 50k, 50k as well, which is nice. So yeah, I think if you're patient, if you can wait for the housing market recovery, when it does recover, feels like we've been saying it forever, but I think, you know, there's some good value in these house builders at the moment. And that takes us on to the last one on the list, which is Revolution Beauty. I did buy Revolution Beauty just to make you aware this is a high risk spec stock. This is very different from all the other companies that I previously mentioned. There is higher risk that this does go wrong, although there is some decent reward here. That's what makes the worth of taking the risk. And it is going to be a smaller position just because of that risk. It's a bit of a fun amount. The money that I'm investing into Revolution Beauty, if it was to go wrong, I would be okay losing 100% of that money. That is what I'm trying to say at the moment with Revolution Beauty. Now the stock's had an awful time, as you can see here, since it IPO'd, down nearly 98%. And at this point, I'd normally say to you guys, they've got great profit growth, great profit margins, great revenue growth. None of that exists with Revolution Beauty. The revenue has been poor, the profit has been poor, the profit margins are non-existent, the balance sheet is an absolute mess. So why would I buy someone like a Revolution Beauty? Well, the reason why is because recently at Revolution Beauty, the former co-founders Adam Minto and Tom Allsworth have come back into the business. They left in 2022 under circumstances and they moved away from the business because there was some issues around, I think, loans given to some individuals and some stock purchases that were a bit, should you be making those stock purchases? So they decided to move away from the business. And since then, there's been a management team that have come in and run the business poorly, as you can see here financially. Now, basically, as a last resort, the co-founders have come back into the business. They have switched roles, which basically, I think the market has accepted it. They have done a capital raising, which manages the debt slightly by diluting the shareholders through a stock placing. And my thought is, okay, with the founders back, previously this business was doing really well. And actually the Revolution Beauty, same again, you're going to have to go ask your missus about some more makeup brands. The actual Revolution Beauty products are actually really, really good. I would even say probably better than Warpaint. But I'm thinking if they can get it anywhere to the level that they were at before they had to leave, then it would be very good for someone like Revolution Beauty. Previously, they were signing massive contracts with the likes of Target, for example, in the US. And they were on the way to, decent growth, decent profit margins. You can see here in 2017, 12% profit margins. And it's just lost its way through innovation, lack of signing deals. And hopefully they come back in, bring these new products out, get these new deals going in. And, this company's still making 142 million in revenue, which on a 10 million market cap is just absolutely incredible. And as we look at someone like Warpaint earlier, and when you look at Warpaint, like the makeup space should be an easy place to make profit. Like, Warpaint have 17% profit margins. I would expect someone like a Revolution Beauty, it should be very relatively easy for them to get back to a 10% profit margin here. There's not many employees, like 222 employees. They've not got many overheads here. I think they've got like 50% gross margins. They should easily be making a 10% profit margin here, and I hope the founders can do it. If they get a 10% profit margin on a 142 million revenue company, you're on about 14 million of profit. Well, 14 million on a 10 million market cap is just absolutely incredible. So that's if they do that. I mean, that sounds easier than what they've got to do here, but if anyone's going to do it, it's going to be the founders. And if they wanted any more incentive to do it, well, you only have to look at who's going to benefit the most. These guys here, Tom Allsworth and Adam Minto, combined between them, they own 30% of the business. So if they want any more incentive to go make this work out for them, well, it's when you own 30% of the business, isn't it? So we'll see what happens. Like I said, that's just a punt, and so just be aware of that one. Very, very different to what I normally invest in, but a little bit of fun there as well. It's definitely fun, and that's what we'll say. The volatility on the share price, maybe not so fun, but that's the last one on the list. So that's the video, guys. Hope you enjoyed it anyway. Thanks for watching. If you could hit the like button, if you're new around here, subscribe, and as I always say, if you could just share it on your investing platforms, on your Discord groups, WhatsApp groups, wherever you have your community investors, that'd be absolutely amazing to help the video get out there. And apart from that, see you in a bit, guys.